ahead and get started. Again, this is the webinar, Smart Tax Tips for year end and beyond. So my name is Skylar Riddle, and we have Craig Koryak on the line as well. We'll go through some housekeeping things to start first on how to interact with us. So if you are on a mobile device, a phone or iPad, you'll see at the bottom there will be a handout section. So we do have a few slides here that you can view while listening and watching our webcast here. That's at the bottom. And then if you are on a desktop, you see an orange arrow there on the top right. That will expand that area. So we encourage you to take a look at the handout, ask questions throughout. We do have several questions that we got in ahead of time. So we'll try to cover those as best we can, and also we'll be sure to leave some time at the end of the webinar for other questions and answers. So you'll see this is kind of what it looks like after you expand it. So, here at Fort Pitt, we are not just financial advisors. We like to consider ourselves life advisors, and really anything that somebody needs, we want them to come to us. Whether it's something with estate planning or something with tax planning, if we can take care of it in-house, we're very happy to do so. But other times we like to partner with folks like Craig and his firm to make sure that we're giving our clients the best expertise. So, we always like to say, before you do anything at all, make sure you reach out to us before you make a financial decision, because we want to make sure we do it in the best possible way for you. Like I said, my name is Skylar. I'm a certified financial planner and financial advisor with Fort Pitt Capital Group. And with me, we have Craig Koryak, a CPA and CVA as well.
Yeah, thanks, Skylar. As you can see, we've been around a bit too. Since 1978, it's hard to believe. We're a full service tax, accounting, business advisory firm, as you see. Have a lot of clients, been around for a long time in the tri-state area. We do everything, audits and everything else. You got a nice little niche with these physicians. We do a tremendous amount of work with physicians, which are obviously good clients, and always looking for more work and enjoy the diversity. The more different clients are, I think, the better for us.
Excellent, excellent. Yeah, we've here at Fort Pitt have worked with Craig and his team for a long time. Craig actually has a solicitor's agreement with us as well. So for our disclosures, that means that if Craig does refer business over to us, then he does get a portion of the management fee. But he does great work. His team does great work, and we love partnering with folks like him to make sure that our clients are well taken care of. So here's a little bit of an agenda here. We like to keep it a little free-flowing in Q&A back and forth between Craig and myself, but we will go over the just basics of taxes. We'll talk about retirement accounts and other work plans. We'll talk about non-retirement accounts, charitable giving, Medicare premiums for those folks that are nearing that age or in that age. We'll talk about what's going on in Washington, D.C., what we see coming in the next year or two, and certainly other questions from you. So with that, we will go ahead and get started. So, I know that taxes at least come up for almost every meeting that I'm a part of, Craig, in our review process, because it's something that it changes all the time. We actually got this idea for our webinar from a webinar that we did a few months ago about estate planning. What happens to your money when you die? And one of the most prominent questions was about taxes. So, I know a lot of people maybe think they don't want to do their taxes until March or April, but year end is a pretty good time to make sure that all your ducks are in a row, so to speak, because there's a lot of things that have to be done by December 31st, some credits and deductions, those sorts of things that you can't push until the next year. So I wanted to at least cover the basics, like we said there. So Craig, could you tell us just high level what's a tax credit, what's a tax deduction, what's the difference between those two things there, please?
Yeah, no, sure, Skylar. Hey, and you hit the nail on the head. I mean, like, what you want to be is you want to be proactive and not reactive. And, for most of our business clients, we try to meet with them quarterly and have quarterly financial statements because it's so important to stay on top of it. And really, in 43 years, it's never been harder to practice. I mean, you've known what happened over these last couple of years with the COVID, with the CARES Act and the Secure Act. It's just unbelievable how things have changed, and it just major tax bills over the last couple of years with things sunsetting or not. So you have to stay on top of it all year. It's not a January to April 15th business. It's all year round. You want to deal with people, and particularly with all the changes we've gone through. You asked a good question. A lot of the times people get, it really mixed the two up, deductions and credits. Credits by far are better. They're dollar for dollar against your tax. The one, hey, Skylar, it's interesting. We have a lot of mutual clients, and most of our clients are in kind of the same situation, economic situation generally. And the one that's come up that's, really been incredible is the child care credit, because so much of it, I'm going way back into the Clinton era. He came up with some pretty good ideas as far as some of these tax breaks for education and everything. But unfortunately, for most of our clients, the income limit pushes them out. But what's been incredible is child care credit. Again, as I talked about, like doctors are a good example. I know you do a lot. We do a lot of professionals, let alone all of our other businesses, the business owners. You generally think they're not eligible for child care credit, but recently that's gone all the way up to $400,000. So credits are golden. They're dollar for dollar. People get, deductions are good. Don't get me wrong. We love deductions, but they're only worth whatever tax bracket you're in. So, a good example, people always ask me, should I gift my car, instead of selling it? And again, I'm charitable as the next guy, and we love to help the charities. But if you could sell it for $5,000, you put $5,000 in your pocket. Where if you donate it, you get 5,000 times your tax bracket. So the deductions are good, but not nearly as good as the credit is the bottom line.
Yeah, and especially with the changes, the increase in the standardized deduction, maybe fewer people are itemizing, and those tax credits are nice for sure.
The last studies I saw, people that itemize, it went from like 31% to 15%. So the increase in standard deduction has really cut that back. We'll talk about later what's going on in D.C., but we may be back doing a lot of itemized deduction when we get to that portion of the conversation. Okay.
Sure. So that's good. So my wife is actually due in early January. So would you recommend that I tell her she should probably deliver that baby before the end of the year to get extra tax credit?
It's never a bad idea. That's right.
No, that's good. So, I know you do it's great that you mentioned you like to sit down quarterly with most of the folks that you meet with. What are some of the big things that you like to make sure people finish by year end, and what are, the other things that can be pushed to the following year?
Yeah, as you know, let's talk about business for a second. A lot of our taxpayers and business clients, since the change to be able to be on a cash basis for anyone with less than 25 million, and we have, a lot of our clients in that range from 25 million down, that they're on a cash basis. So a lot of these things you actually have to write checks or put on your credit card by December 31st. So that's what you want to plan on. And the other thing, what you want to do, I think a lot of people have missed is with Trump's last tax bill that he passed, it's just amazing how far out the 24% tax bracket goes. It's almost up to $330,000 for married filing joint. So what we try to do with a lot of these things is to try to get people into that 24 and try to keep them in that 24% bracket. So Again, from a business standpoint, it's just amazing with equipment and furnishings and even leasehold improvements. I mean, leasehold improvements used to be a horrible tax issue because you had to write it off over 39 years. It was incredible, even by lease. And, with these accelerated depreciation changes over the last decade, they've been a home run for our clients. So those are the things you want to look at, try to get it from that 32 down to that 24. And I said, there's a wide range of that. And we'll talk about that a little bit when we talk about Roth conversions too, because we haven't seen tax brackets that low in a long time, and again, we'll talk about proposed changes, but luckily it may stay that way, it looks like. So those are the kind of things we go over. And one of the things we'll talk about coming up here too is the retirement plans. That's one of the, I still think for our type of businesses in the, million to 25 million range, the biggest asset for these business owners are these retirement plans. And we could talk about a little bit about that also.
Yeah, absolutely. I mean, that's good. That's a good segue is going right into retirement plans, because that's something you kind of have a little bit of both there. You have a work plan, which generally those are contributions that you make throughout throughout the year from your payroll if you're just a regular employee, or even if you're the owner. So that's, you don't really make extra contributions to that by the tax filing deadline. Certainly, depending on your income level, you could make IRA or Roth IRA contributions the following year to have it count before. But I mean, that's a great way for anybody, regardless of income level. If you have a work plan, you can put in money and avoid, and have that be pre-tax contributions, right?
No, that's correct. And again, from the employee side, which a lot of the listeners probably have 401ks, again, what you always want to look at is what bracket you're in and what bracket you think you're going to be in when you go. And boy, that's a loaded question in today's world, especially what we've gone through the last 2 years with all the spending, where rates are going to be. But it's, again, I think the best asset out there as far as, trying to get the money into 401k, let it grow over decades. And where it gets tricky, again, going back to the business owners, because they've made extreme changes to the benefit of business owners. I mean, it's interesting. I've been doing this for so long, but when you go back to 86 was the first major change. I mean, probably the biggest change we've seen in our career. And what they did, they made the plan so restrictive for the business owners, where you had to put so much in for the employees and not the owners. And what happened? They got rid of a lot of these businesses, got rid of the retirement plans because it just got too expensive. So they put provisions in like the safe harbor 401k, which has been a home run. As long as you put 3% or you put a match, roughly a 4% match in for your employees, these business owners were able to put their 19.5, which it is now, 26,000 or 50 years old. They were able to put it no matter what their employees put in, as long as you put 3%. And again, a lot of these businesses do very well, and it's just incredible the amount of money you can put away. The limit into these retirement plans, defined contributions, are all the way up to $58,000 plus another $6,500 if you're 50 years old. And we have just so many clients who are doing that. And the other thing, business owners, is not a bad thing to look at, is these defined benefit plans that we had a bunch of them before 86. Then 86 kind of put them out of business. But the same issues, we all know, other than Medicare, Social Security is probably the biggest burden on the government to fund. And with these people who are doing away with their retirement plans, they had to ease the restrictions. And now, for a lot of our little, for the business owners who are doing well, not only can they put that full amount to 58,000 in the 401k, but you can couple with the defined benefit plan, which has been, extremely good for a lot of our small business owners. And
Yeah,
it's good for
absolutely.
employees too, Skylar. It's as we all know, it's so hard to get good employees these days. So retirement plans are a big part of it to keep them.
Yeah, it is. It is. I mean, we do a lot of 401k business as well, and a lot do exactly what you're talking about. Have that safe harbor election there, where it's great that they contribute on behalf of employees, and then it gives the employees the ability to save on taxes, and it gives the business owners the ability to save on taxes. So really, it's beneficial to everyone there. So certainly we always encourage people to take full advantage of it to the best of your ability, and that goes for other things too. Any other additional benefits like health savings accounts or flexible spending accounts? I mean, those are accounts that you use for pre-tax dollars as well. So I mean, it seems like it's a no-brainer to contribute to a health savings account if you have that, or if it's a flexible spending account, if you know what your bills are going to be in a year, at least put $1,000 or $2,000 in that, and then you pay that with tax-free funds, right?
I agree 100%. Yep.
So I know you talked a little bit about Roth conversions. So that's something that we get asked a lot about as well. So, I want to pull up a slide here, and I want you to kind of talk through your process as well, because we as the advisor, we know a little bit, and we know the tax brackets, but really there's so many other things that go into making the decision to should you convert money from a regular IRA to a Roth. That's when we usually like to loop in somebody like yourself. And just for the folks that are listening that maybe it's a new term to you, what we're talking about with a Roth conversion is we are taking money from a pre-tax retirement account. So it could be your work 401k, or it could be a traditional or rollover IRA, and we are taking a portion of those funds and moving it to a Roth IRA. We are converting it, so you're paying taxes on that. So it can be a good planning tool, but Craig, please, talk about what you usually go over with your clients when you're making that decision.
Yeah, and this is a good chart that that you guys put together, and I read it over last night, and it makes a lot of sense. Just with all that written there, to me too, it comes down to a simple question, but sometimes not easy to answer, as we said, because the ever-changing tax laws. But the answer is, what bracket are you going to be in now, and what are you going to be in when you take this money out? Okay. I mean, there's a couple people in town that, are saying everybody should do Roth conversions, but I'm not one of those followers. Here's the reason why is so many of our clients are in the 35 or 37% bracket. Okay. If you convert, you got to pay 37%, on that money. And that's a lot of money to be setting, the government having now and not to grow. And again, who knows what's going to happen with rates? None of us do, and it's concerning. We all kind of probably think rates got to go up at some point. But again, when they say that 37 goes to the 39.6, it's not like every dollar gets taxed like that. We're still going to have to graduate at rates. So going back to what I said earlier, which I think is so important, is, and again, this is with married filing joint, I should mention too, which, the majority of our clients are filing. That 24% bracket goes all the way up to $329,000. So no matter what you have, and as you know, and I know with certain clients you have, with the market the way it is and what you guys have done, a lot of our clients literally have millions of dollars in. But still, with the RMD, people are so worried about RMD, but you know how the tables are. They have changed it from 70.5 to 72. But still, when you start, you're only taking about 4.5% out. It's not like even less than that. With the 70.5, it could be 3.8%. So even if, like the example I gave, even if your RMD is $240,000, I mean, think where you're getting that taxed at. The net effective tax rate of that under the current tax structure it's going to be less than 20% probably. And it obviously depends what you have in Social Security. It depends what other investments you have. So why in the world would you want to pay 37% today, give it to the government, when you can take this money out at 24%. And again, I can't say enough that we're guessing what's going to happen with tax rates and things. But I mean, even with Biden, who's really had to give in a lot to the left, I mean, he wants to keep it below, you know, anyone making less than 400,000, their tax rates aren't going up. So how long they'll keep that, who knows? But I just don't see it. And believe me, I think Roths are the greatest thing in the world. They're just so hard to get to. It's so expensive to get to. And the couple that are no brainer, you know, I've done with my children, and you know, and I tell clients to do all the time, is you know, even if a lot of them can't afford it in their 20s and 30s, if you're ever gonna, if you have the means to do it, you want it. I mean, the best thing you can do is give them that 6,000 every year and put it in the Roth, you know. And the other thing, what I have, like I have a lot of these young guys coming out of school doing really good in techs, or like the young doctors coming out, they don't have IRAs. So what's available to them, again, this is a no-brainer if they have it, is, you know, you do the backdoor Roth. You know, no matter what you make, you can do a traditional non-deductible IRA. What you do, you have them put that 6,000 in. The next day, you convert it to a Roth, and you get your 6,000 and let that build. So to me, those are no-brainers as far as Roths. And again, who knows if they'll ever change? I mean, I've been around too long, you know, I'm so skeptical. And what I think is going to happen, particularly if this market goes, and this is the other thing why I'm hesitant with the Roth, knowing what they do in Congress, and particularly if we get further to the left, I can see them putting surcharges even on Roth. Politically, they won't be able to do away with these or change them. Their grandfather, but I could see what they did in 1986. I mean, what they did in '86. I mean, you talk about, you're like playing a game and they're changing the rules in the middle of the game. They made any distribution over 150,000 out of a retirement plan subject to a 10% penalty. I could see something like that coming back with these Roths, because people have just accumulated so much in their IRAs because of the investment performances over the last couple decades. So it's something to take into consideration.
No, for sure. And I think you hit on a couple of things there that I'll, you know, drill home as well. And I think it's, you know, on this chart, the tax payment is one of the biggest things. Is, you know, do you have enough money to pay for the taxes out of pocket? Because if you're paying for it from the conversion, then that's less money that's in the retirement account, less money for that to accumulate in value. So, you know, I like to treat it as a, you know, case by case basis. Maybe somebody had very high charitable deductions in a year, and they're in a lower bracket than usual. So sure, maybe we convert a little bit to, like you said, get to the end, the precipice of that next tax bracket, and sometimes that makes sense. Or sometimes it could make sense if somebody is retired and they don't really need a lot to live on, and they're before the RMD age of 72, where they need to take money out. Maybe they want to convert a little bit there. But I'm in agreement with you that most of the time, converting, you know, big dollar amounts, it's really, you know, not going to be beneficial in the long run. It just takes too long for the tax benefit to outweigh itself. And like you said, you're not sure. We don't know what tax rates are going to be in 5 or 10 or 20 years. So, you know, let's work with what we have now. And yes, we can work with our folks to convert a little bit, because, you know, yes, it saves you in required minimum distributions. It can be a good estate planning tool for folks, because, you know, the money that would come out of the Roth when your family inherits it, they're not going to be paying taxes on it. But if it's really going to push you into a higher bracket, or I know we'll get to this in a little bit, if it's going to push you to higher Medicare premiums, then that's something else to consider as well. So I guess bottom line is, to anybody who's listening, before you convert to a Roth, make sure you talk with us, because there are a lot of other things at play there that most people don't think about. But I'm glad you mentioned backdoor Roth, because it coming from you, Craig. That's great, because you are a CPA, and I know I mentioned backdoor Roth IRA, and some people think, oh, that's a shady thing. That's, you know, you do it under the table. But it's a perfectly legal and great way to get money into a Roth, the way the rules sit right now, no matter how much money you make. So that's something we do for a lot of folks as well, because you're right, you know, getting even $6,000 into a Roth IRA early on, the growth rate, it's really going to be beneficial for folks.
Yeah. Hey, Skylar, let me mention, you brought up a couple good points. Let me follow up on two things really important, as you said. What we run into a lot is the guy that retires at his early 60s and, you know, has sufficient other money to live on. They're the perfect candidates to convert to Roth during that 10-year period before the RMD is due. And we do a lot of that. Again, we'll maybe say, hey, we'll take it up to the 22 or 24% bracket. That's a perfect situation. And the other thing that can change my mind too, and again, as I said, it's never been so difficult, and even, which we'll get into, what's going on in D.C. You think the PPP and the employee retention credit was bad, but these bills now with the Democrats fighting there is incredible. But the huge issue that may force a lot of our clients to do Roths is the estate tax exemption. You know, right now, as you know, it's like 11.6, so we're but you know, they're talking about that going down to 5 or more like 6 million probably, because they're going to take the 5 million and index it. You know, again, with the run up in the market and even you know, investments not in there, that's where I could see a lot of our clients almost being forced into converting to Roths, because what's really bad, not getting too technical into this estate tax, but what's horrendous is when you have when you pass and you have money in a 401k or traditional IRA, that, even though that money isn't really worth what it says, if you have 10 million in there, it's really not worth 10 million because someone got to pay tax on it. But for estate tax purposes, it's treated as 10 million. So you're going to pay this 40% on that money, even though someone is going to pay tax on it. There is a way that it gets mitigated somewhat because the recipient gets a tax deduction on their personal return. But you do not want to pass with money in those retirement plans and have to pay estate tax. So if this does go through, this bill, and it does reduce the estate tax down to 6 million, we're going to probably look at a lot of people doing Roths and you know, again, for all these clients, it's a nice position to be in, but it kind of makes you work harder and maybe lose some more sleep because of what you've accumulated. But I'm sure some of your listeners are in that position. They're going to have to think about it.
Absolutely. No, that's good information, and you know, it's good that, you know, we're all keeping up with the changing times, because we don't know what it seems like it changes daily. So we'll shift gears a little bit and go to, you know, non-retirement accounts there. So it's something that, you know, retirement accounts are great for people maybe that are maxing out their 401ks or their IRAs, their work plans, and they still want to set money aside and get better than 0.05% that they're getting in their savings account. And there's no restrictions to that. So there's great flexibility. But a lot of times what we see is folks get, you know, kind of a surprise tax bill at the end of the year, or they have realized taxes, I should say, that come in usually in December, and that's in the form of dividends and capital gains. So, you know, that's all shown on your tax forms when you file that is income earned from investments. Even if maybe you didn't sell a mutual fund or something, but if they have a distribution, then you as the investor are realizing those gains, and that goes on your 1040, right, Craig?
That's correct.
Yeah. So, I mean, you know, depending on your circumstances, I mean, this is something that we like to do here at Fort Pitt as well, is we, like I said at the beginning, we do a lot of in-house, all of our research is done in-house. And depending on your situation, we'll look at doing individual stocks or individual bonds in a taxable or non-retirement account as opposed to mutual funds. And that's because we can control it a little bit more. So if you have a portfolio that is invested in mutual funds or exchange traded funds, there's going to be dividends and capital gains, and usually we've seen a lot of the estimates this year. It seems like they're a little bit higher, And Craig, what's the dividend what's the percent that you pay on capital gains and dividends for taxable accounts?
Yeah, most of it is at 15% to the feds. That, then if you go over 250, for again, this is married filing joint, you get hit with the 3.8, and then if you go over like 500, 501, it goes to 20%. So,
okay.
Hey, Skylar, the one thing that's really important, again, like why we like working with you is, by doing the individual stocks. I mean, people don't realize how important that is. I mean, one of the worst things in our business with clients, the market's been good the last couple of years, but we always have a couple down years. You have to. But a person's portfolio will go down, but they get hit with the capital gain distributions. They call me and say, "Are you crazy? I didn't have any money. What are you saying?" But as you know, those capital gain distributions, I mean, there's some your competitors out there. I mean, the majority of their funds are in these mutual funds, which can be horrendous from a tax standpoint. That's why individual stocks, I think, are way better.
Yeah, absolutely. We agree. And there's a not, without getting too technical, there's a ratio out there that's called the tax cost ratio, and it's basically a drag on the performance. And the average ratio of just a large mutual fund is about 1.8%. So what that means to our listeners here, our viewers, is that the average fund, 1.8% of that of your gains are eaten away from taxes. So if you're up 10%, you subtract almost 2% from there just from the taxation every year. So something that we like to use as well with the with our taxable accounts is you mentioned it perfectly, that the market fluctuates. So in this chart here, we see, this is from JP Morgan, and this goes back all the way to 1980. So the average downturn intra-year is about 14%. It's a little more than 14%. So what that means is that most of the time, the market is going to be down from its top to the bottom of the year of about 14%. But what you see there is over 75% of the time, the market ends the year positively. So what this is showing is that number one, it's a good guide to say that we're not market timers, and it's good to stay invested and stay the course if you have a good financial plan. But also, if you're working with some smart tax planners and smart money managers, you can use this to your advantage. And what you would do is something called tax loss harvesting, and that's on this slide here. So a quick example is if you purchased a stock for $10,000 and you happen to purchase it at a wrong time and it went down to $8,000. Well, what we can do to save you taxes is sell that security for $8,000, buy something very similar. Maybe we, sell Home Depot and buy Lowe's or Pepsi and Coke, or, something, two similar, companies there. You can pick. And what you'll see there is you'll be able to write off that loss of $2,000. And this is just using a 23.8% tax rate. So that saves you $476 of real money by, when the market took a downturn, we were proactive and made a change in the account to your benefit. So you're still staying invested, but you are realizing a loss there. Maybe you use that to offset gains, but this is a way to keep more money in your pocket while staying invested. So Craig, a question that I'd like you to answer is tax loss carry forward and those things there. So how much is somebody allowed to write off from a capital loss every year? And if they exceed that, are they allowed to push that forward to other years?
Yeah, for federal, you can, Skylar. You're allowed a maximum of $3,000, and you net the short term with the long term. And again, we should mention the short term is bad. You know, that's ordinary income
Right.
tax. It's nice to make the money quickly, but from a tax standpoint, it's bad. But you net the two, and if there's a loss, you get the 3,000, and then you carry over the difference the following year, which is important. I'm sure most of the listeners are Pennsylvania residents, and or a lot of them are, I would assume. But you know, again, Pennsylvania, what they get away with this stealth stuff you don't see is horrible. Mm-hmm. They don't let you carry over losses, so that's something to take into consideration too. Although PA is only 3.07%, but still, it seems so unfair. You know, you pick up all the gain, but if you have a loss, you can't carry it over the following year. So, but that's what the law is right now.
Okay, good. Thank you. So it's just, you know, bottom line, it's important to make sure, you know, if you're meeting with your advisor semi-annually or quarterly, or you're meeting with Craig, I mean, we're making sure that we're staying on top of these things. And we're not market timers either. We're never going to be able to sell at the absolute bottom, or excuse me, sell at the absolute peak and buy at the absolute bottom there. But we do our best, and we do a really good job saving our clients tax money, having more in their accounts. So at the end of the day, you can use that money for whatever you want, and whether that be for your family, for yourself, or, you know, our next topic, which is charitable deductions. So I know charity is, you know, Pittsburgh, it's great living in Pittsburgh. I know not everyone on the webinar is from Pittsburgh, but we're a very generous and giving town, I feel like, and there's a lot of places like that. So tell me a little bit about charitable deductions. I know, first of all, Craig, that maybe some people feel like they've stopped doing it as much because the standardized deduction went up. Is there a dollar amount that you can deduct even if you don't itemize?
Yes, currently you can get $300 above the line, and again, they're proposing that to go to 600, but that hasn't gone through yet. So that helps a bit, definitely. Yeah.
Yeah, good. So that's good. You know, to at least get a little bit there. But then also, we've spent a lot of time talking about required minimum distributions, and some folks have, you know, big RMDs that they have every year. So, and a lot of people are very charitable, and many people just contribute out of their checkbook, or they go to church every Sunday and they put some money in the basket there. So could you talk a little bit about QCDs or qualified charitable deductions there from retirement accounts, Craig, please?
Yeah. Again, I think this is a fantastic thing. You know, unfortunately, you have to be at qualified age too, of 70 and a half, to do this. But you and I talked about this a little bit last week too, Skylar, is that the best thing to do with these IRAs to have a checkbook. I know a lot of these clients, they feel guilty, you know, maybe writing a check for $20, but you know, why not? If you have a checkbook, you can write out of your personal one for $20 if you go to the, you know, someone comes to the door, or if you're going to mass, what you're putting in there. But certainly any bigger amounts, you know, 100, 250, I mean, you have to do them through the through the IRA. It's the best way to do them if that's your intentions to do it. And as you mentioned several times already, so many people don't itemize because they don't even get a deduction for the charitable deduction. So by doing these through the IRA, you offset it dollar for dollar to, you know, the taxability of that IRA distribution. And you know, I told you, a lot of these people in town, the brokers, I say, you got to give them a checkbook, you know, and it's easy to handle. It's just like writing a regular check, and it's, from a tax standpoint, it's a home run to do that. You know, the one other thing, like when I told clients, the two best ways to do to charity is the one you're mentioning through the IRA, and then the other one is appreciated stock. The only thing you got to be careful with is there are limitations. You know, the general rule used to always be 50% of the fair market of your adjusted gross income, the limitation. But now with the CARES Act, you know, with non-appreciated stock, it's all the way up to 100% for a window here. But no, I don't know why anybody would ever do that. You're not getting the tax benefit because you want to get the charitable contributions to, again, I'm talking purely from the tax standpoint when you're in a decent tax rate. But the one that's really good at, for your people that are under 70 and a half is appreciated stock is the way you go. And again, like even if someone says, hey, I don't want to sell that, I don't want to give that. I mean, what you can do instead of giving a check, like, Apple's a perfect example. So many people have, and they've made money on it, that you give, you give 100 shares of that, if you're doing a pledge for a religious organization or for any type of 501c3, and then you could just buy it right back, because then you get the step up in basis, but then you never pay tax on that gain. So, and the one thing that you do have to keep into consideration for the appreciated stock, though, it's limited to 30% of adjusted gross income, but generally that's still a lot that, more than most people are going to do anyway. So I think those are the two best ways to do it. And two other real quick things, though, on the contributions out of the IRA. A lot of people want to, for their RMD, try to convert that to a Roth. That doesn't count for the RMD, but these contributions do, which is really a good thing to do. So, okay.
Yeah, that's terrific, because you're right. A lot of folks, maybe they're on Social Security or other things, and they don't need their full required minimum, but they have to take it and they have to pay taxes on it. Well, it's a great way to give back to things that you care about, and it's a good way to save on taxes too. So that's perfect. And another strategy that I know that you like to use as well, and we do as well for some folks that maybe don't typically itemize is a kind of a bunching strategy. Maybe they do have a good year and they want to gift some highly appreciated stock, and you can put it in a donor advised fund. Now this would be separate from a QCD now, but you could put something in there and kind of a larger lump sum, get a bigger tax write-off in that year. And you could do that every few years, where you itemize, this year, and then maybe you use the standard the next couple of years, and then, you can itemize again, right?
Exactly right. Absolutely. And we probably should mention, which you kind of touched on, which seems so unfair, but you can't do, to get the qualified charitable deduction out of the IRA, they don't allow it for a donor advised fund. Doesn't make any sense to me, but that's the case. But you're absolutely right. For the people under the 70 and a half, it's a perfect thing to do is bunch these appreciated stocks and, take the standard for a few years.
Absolutely. And we have another advisor's doing a webinar at the end of the month about charitable giving, so I'm sure they'll go into greater detail as well. But those are at least a few tips that you can take advantage of now. And another topic that this was probably 1B with Roth and Roth conversion, and that is Medicare. And what can we do for folks that are close to that age or at that age? So I'm sharing my screen here that kind of has the Medicare premiums. So I know this is different. This is different than a normal tax bracket chart, because that's, as you alluded to earlier, it's not every dollar you pay in the 24% tax bracket is at 24%. It's progressive. But this is more like a cliff, right? Yep, exactly. So these are some numbers that we do our best, alongside you, Craig, and the client, to make sure that we are factoring this in, because most people are going to be paying $148.50 per person per month for their Medicare Part B premium. So that's something that we can factor in most of the time. And then you see it does go up. Now the first jump isn't a big jump, but you can see there over time, if you make $222,001 as a married couple, well, now per person you're paying $297 as opposed to $148.50. So I know that this calculation is a little different. This is your modified adjusted gross income. So Craig, is there anything that folks can do if they're pretty close to, one of the thresholds to limit this?
Yeah, and it's tough, as you said, and the thing you and I had talked about, it's cliffs too. I had a client, you could see his adjusted gross income was like $222,200, and he said, "You kidding me?" But as we talked about earlier, but when I'm looking at this in April, it's too late. It may be too late, because one of the problems is, one of the best ways to be able to get a deduction is, possibly doing an IRA. But when we're dealing with Medicare, a lot of them aren't working anymore, so you don't have that option. So you kind of got to do the planning before the end of the year, and some of the ways to reduce it is, look at your capital gains is a perfect example. If you have losses, which you talked about earlier, that's how you can bring this down. And you kind of try to do the best estimate you can at that point. There's certain things out there as educator expense, and even in the proposed bill, there's some, that we talked about, the charitable contributions. Those things on the front of your tax return you can look at to try to get it done. But you got to do it, before December 31st. And a lot of times it's not perfect because you kind of got to work off your November statement. And again, which you don't have much of, but some of these other brokerage firms do, is they have these mutual funds. And boy, as you know, you really can't get a handle on that until like at the end of December. So that's what a lot of people get knocked into another bracket from, for this Medicare premium that they end up paying. And it's just incredible how the Medicare recipients are cognizant of this. It's almost like when I'm doing tax projections now, this is just as important. And it's real money. And in these numbers, which you have to take into consideration too, when it's married, it's times two, so, it can be, and these different brackets here, they're roughly $90 each times 12 times 2. So it's not, it's nothing to just ignore. It's a couple $1,000 for sure. So it's something that needs to be taken into consideration in your planning.
For sure, especially like you said, most of these folks are not working anymore, so you're on somewhat of a fixed income. So one thing that we like to do with our, even if someone is not in an individual stock portfolio with us, we'd like to build a capital gains budget. And we know what's coming in from Social Security. We know what you like to give to charity, so we know where your income is coming from, and then we can see, well, how much wiggle room do we have to get to keep you under a certain bracket for that planning, and then that allows us to manage your account appropriately. So sometimes we do need to sell some investments at a gain. Hopefully we've made some money in the account and it's not all flat, and some of our stocks pay dividends. So we use all of that to come up with a good budget to make sure that folks stay in that bracket there. So I think you said it exactly right, Craig. You need to make sure you're planning for this every year, beginning of the year, middle of the year, and towards the end as well, to see where you are on that threshold. Craig, a question came in that I wanted. Go ahead. Did you want to add something, please?
I was, but I think it's really important. As you can see on your what we have up there, is this 2021 is based on your 19 return. Again, it's one of these things that's been evolving over the years, because this is relatively new. For me, anything that came in the last 10 years is relatively new. Things change so quickly. But what you could do, if you retired after 19, you can file an appeal. And a couple of my clients have been very successful, and a lot don't even know how to do it. They don't do it, but you have significant savings. Instead of paying $504, if you can get it down to $148, we're talking about significant dollars now to save, particularly for married. So I think that's important. A lot of people don't realize you can do that.
No, that's a good point, because a lot of people, maybe they just don't want to go through the motions, or that don't, probably more often, just don't know about it. That just, I had a big year that year, and now I'm retired, so I have to live with that. So that's great to know that, you don't have to just sit there and take it, so to speak. You can file an appeal just as you would sometimes, you know, for your homeowners. You might be able to get a lesser appraised rate there. So that's really good to know. A question came in about our last topic on QCDs, and I wanted to know if you could shed a little light on this. So RMDs, of course, that changed to 72. So folks can take their RMDs at age 72. You're not required to take it earlier. For QCDs, do you still have to wait until you're 72, or can you take a QCD when you're 70 and a half or 71?
It's still 70 and a half. It's still 70 and a half. Yeah.
Good. Okay. Thank you for that. So the last topic is, you know, about what we think. You know, I'm going to ask you to pull out your crystal ball. I've got mine out here. So what do we think is going to happen in the next few months with the different bills that we've seen, the legislation proposals? What do you think is going to happen in the next few years? And really, I know our job isn't to predict the future or to say what is right or what is wrong. It's you know, we want to make sure that we're preparing our clients for whatever the case is. So what do you see? Because you're probably your ears to the ground a little bit more on the actual tax numbers there.
Yeah, and believe me, I'm absolutely flabbergasted what I'm reading here. What it looks like is going to happen is the concerns we had about capital gain rates going up, the tax rates going up, estate tax exemption going down. Right now, it appears they're off the table. And it's too hard to believe after doing all this, but I guess the two most powerful people in the country are the Senators Manchin and Sinema, you know, and Sinema is a home run for my clients and our business, you know, because she held out, and they apparently have taken that out. The infrastructure bill was signed, as you know, or passed by the House, and there's no provision in there. And, you know, so then we go to the next, you know, the bill that's out there, and Build Back Better. And right now, all those provisions were in there, but October 28th, I guess they slimmed it down and they removed these increases, which is absolutely incredible. There are still things in there for people over $10 million. They're going to get surcharged, and there's some other income tax provision, but one of them is a good one. It looks like they're going to bring SALT back, you know, where you can take the state local income tax, which, you know, will be again a home run for our clients. You know, they've been limited to $10,000. That's why a lot of people can't itemize. But if they bring SALT back and they're talking about limiting it to 75,000 or 80,000, that's a vast majority of our clients are going to itemize again because of that. And it looks like it's going to go through because they got a lot of pressure, the Democratic Party, from their California and East Coast states, senators and congressmen, Congress people to do that. So that's what I think's happening now, which is absolutely incredible from my little world of tax. It looks like they're going to leave those out. I mean, as you know, Trump's stuff sunsets in a few years, so I think they may just let those different tax breaks sunset and not bother it, because some of these more moderate Democrats are so against any tax increases, obviously, for their ability to get elected again.
Yeah, absolutely. You're right. And that's, you know, I think there's been some big numbers thrown around at first, and I think those numbers will definitely be a lot muted. I have a slide here that I wanted to show as well that kind of showed, well, what happens in the past when the tax rates have gone up. So here at the bottom, you see personal income tax. When did that go up? Corporate income tax and capital gain income tax. And this goes back all the way to 1950. And you can see in 1969, the S&P, you know, the market index was negative. But look at all the other years. So, you know, certainly we have no idea how it's going to affect it specifically in the stock market there, but we know that we've seen this happen before. Tax rates have gone up in the past. So if you're working with someone like Craig and an advisor here with Fort Pitt, we'll make sure to keep you on track and making sure your retirement accounts are growing and that you're saving the right way. So I know we've got about 5 minutes left. So I want to just again let everyone know that we do have a charitable gifting strategy coming up here at the end of the month. So we'd love to have you join for that. It's been a pleasure having you join us here. I want to open up to Miranda, who has been a great help setting this up as always, and see if any other questions have come in from the group that we can answer here. But I guess while I'm waiting for those to come in, I think that the main point of this is that everybody has a unique strategy. So you could be a sole proprietor, LLC. You could be, one of 30,000 employees at a big Fortune 500 company. We know that your income tax and your portfolios are unique. So we'd love to get to every single specific question. But we know that we wanted to keep this at least high level and hopefully give some folks some good ideas. But you can always reach out to us if you're not working with Fort Pitt to have a free review of your portfolio. So maybe you do have taxable mutual funds, and it's no cost to you to have us take a look and make sure that you're not getting hit with too much in taxes there. And Craig, I'm sure you do something similar. If somebody is questioning whether maybe they should switch an accountant, or maybe it's time to switch from TurboTax to work with somebody, is that something you work with as well?
Oh yeah, definitely. Yes, certainly a free consultation to look at your tax situation. No doubt, we'd appreciate that.
So perfect. So I'm just looking here to see if any questions have come in. Craig, thank you so much. It's great to see you, and look forward to continuing to work from you. I don't have any other questions coming in yet. Let me look at the pre-filled questions here. So if we didn't answer your specific question, we'll definitely reach out. Again, please reach out to Craig or myself if there's anything that you need, or reach out to your advisor team. With that being said, I'll let everybody go. And Craig, thanks again for your time.
I really appreciate it, Skylar. Thank you.
All right. Thanks, everyone. Take care.